Wall Street ended yesterday in a holding pattern, with the three major indexes closing virtually flat. The Nasdaq settled at 25,709.43, the S&P 500 at 7,383.74, and the Dow Jones at 50,866.78, all with 0% change. Individual names like IBIT, QQQ, SPY, NVDA, TSLA, MSTR, and ARKK also showed no significant movement. But the picture changes dramatically when we look at pre-market futures. Nasdaq futures are surging 1.74% to 29,541.50, S&P futures are up 0.92% to 7,461.75, and Dow futures are gaining 0.58% to 51,003.00. This strongly suggests a tech-led rebound when U.S. markets open today. On the macro front, the 10-year Treasury yield dropped 13 basis points to 4.53%, signaling easing liquidity conditions. The VIX fear gauge plunged 13.06% to 18.70, settling comfortably within the normal 15 to 25 range. This indicates a significant recovery in market sentiment from last week's jitters. The dollar index DXY slipped 0.15% to 99.89. A weaker dollar provides a tailwind for emerging markets and risk assets. WTI crude fell 3.03% to $91.74 a barrel, easing near-term inflation worries. Spot gold rose 0.95% to $4,350.40 an ounce, supported by dollar weakness and safe haven flows. Putting it all together, the VIX retreating, Treasury yields declining, and the dollar weakening point to a broad recovery in global risk appetite. U.S. stock futures are moving higher across the board, and the risk-on window is open. Turning to China, the onshore dollar-yuan exchange rate stood at 6.7796, while the offshore rate was at 6.7806. The yuan has strengthened for a second consecutive day, significantly easing recent depreciation pressure. A stable yuan helps shore up foreign investor confidence in Chinese assets, and we see a high probability of net northbound capital inflows today. On trade and tech policy, Reuters reported on June 6 that the U.S. Commerce Department further tightened export controls on AI chips to China, placing certain high-performance GPUs on a presumed denial list and requiring third-party countries like Singapore and Malaysia to impose additional licensing reviews on mid to high-end chips transshipped to China. Separately, the Wall Street Journal reported on June 7 that the U.S. Trade Representative is reviewing an extension of the fourth batch of tariff exclusions on roughly $30 billion worth of Chinese goods. The bottom line is that tech restrictions are intensifying, but the tariff exclusion review sends a modest de-escalation signal. For today's A-share market open, we expect a flat to slightly higher start. The reasoning is straightforward: strong U.S. stock futures, a strengthening yuan, and a falling VIX. However, after yesterday's sharp sell-off, with the Shanghai Composite down 1.7% and the Chinex down 3.69%, sentiment still needs repair. So the upside gap is likely to be limited. Looking at the global macro thermometer, the 10-year Treasury yield at 4.53% is on a clear downward trend, a liquidity signal that favors growth stock valuation recovery. The VIX at 18.70 is in the normal zone, showing a recovery from last week's panic and rising risk appetite. The dollar index at 99.89 remains weak, making emerging market assets more attractive and increasing the odds of foreign capital returning to A-shares. WTI crude at $91.74 a barrel is easing inflation expectations and reducing pressure on the Fed to hike. Gold at $4,350.40 an ounce has dual support from a weak dollar and geopolitical, and we maintain a bullish view. For the A-share market today, the Shanghai Composite is likely to stage a volatile rebound, with an expected gain of 0.5 to 1.5%. The Chinex index should show greater recovery elasticity, potentially rising 1 to 3%. The logic is simple: yesterday's oversold conditions, plus a strong Nasdaq futures rally and yuan appreciation, create room for technical repairs. The main line to watch is artificial intelligence, computing power, and semiconductors. The Nasdaq futures rally directly lifts tech sentiment in A shares, and the news of Nvidia and SK Hynix cooperating on AI memory provides a catalyst for the supply chain. On the risk side, be cautious with agricultural equipment, heavy machinery, and copper, aluminum, and steel sectors. The U.S. Section 232 tariff adjustments, effective June 5, impose a 25% tariff on these industries, which could weigh on export expectations. As for northbound capital, the probability of net inflows today is high. With a weak dollar, a stable yuan, and strong U.S. stock futures, historical patterns show northbound net inflows exceed 70% under this combination. In summary, with the dollar weakening, the VIX falling, and Treasury yields declining, the risk-on window is open, and A-shares tech sector should lead the recovery rebound. Our probability assessment for today is 45% for an up day, 40% for a flat day, and 15% for a down day.